Welcome to the Savings Guru podcast. Today I'm joined by Marklew Rice from Rayan Bank. Mark's the head of savings,
head of product management.
Head of product management, even better. It's really good to have you on today because I'm really interested, and I know there's an increasing interest in finding out more about Sharia banking, and obviously you're one of the few in the UK that are doing it. Perhaps you could sort of kick us off and tell us a little bit more about the history of Rayan Bank and how they started in the UK, and what was the kind of decision to come to the market.
Yeah, well, firstly, thanks for asking me here today.
You're welcome.
So Rayan Bank actually is quite an established bank. So we started in 2004. We actually started as the Islamic Bank of Britain. And I think the guiding principle of the bank originally was to establish a bank that's based on the Islamic faith. So you may or may not know that in Islam you can't pay interest, you can't pay or receive interest. And the founders of the bank wanted effectively to create a bank for people that wanted to follow the Islamic faith. Although the reality is we don't see ourselves as a bank exclusively for Muslims. As far as we're concerned, we're a bank for anyone of any faith or none. So like I said, that started about 2004. We subsequently were taken over by Mashraf Al Rayan around about 2014, rebranded to Al Rayan Bank. And that really is probably the bank that most people, certainly outside of the Muslim faith, would be aware of. That's the bank that appears in the Best Buy tables.
Yeah, I do remember the old Islamic Bank of Britain day. I've got to say, your new branding's a lot better than the old one.
The old branding was eye-catching, to say the least.
You touched on a bit of it there. I mean, the biggest difference is around the not being able to pay interest, and you pay what's called expected profit rate. Now I know to all intents and purposes, to savers who read the Best Buy tables, that will look very much like one and the same thing, but there are differences. Yeah. Can you explain a bit more about how that works and what those differences are?
So in Islam, money itself is not a commodity.
Yeah.
So if you think what interest is from a conventional bank, effectively you're lending your deposit to the bank and they're paying you for the use of that money.
Yeah.
And that isn't permissible in Islam. So whilst you can earn a return on money, the money itself is not a commodity you can earn a return on. So the difference is with an Islamic bank is that when you deposit with an Islamic bank, you are effectively becoming a partner with the bank. The bank will invest that money in a tangible asset. For us, that's the majority is property. The bank will obviously earn a profit on that property investment, and effectively we will share that profit with the customer.
Yeah.
So the key difference you get is that what we quote is an expected profit rate, because obviously profit is not guaranteed.
Yeah.
So what this means in theory, we might actually pay less than the rate that we publish. The reality is we've never done that. The flip side is also true, that every now and then what actually happens is that we make more profit and we actually pay a better return than the return that we've highlighted to customers. So this is the key difference, is that whilst you still get a return, it's not guaranteed. There are lots of measures we have in place to ensure that we will always be able to guarantee that return. So we only invest in low risk assets. They're all of our investments are backed by tangible assets like property. And then we have mechanisms like a profit stabilisation reserve. So the bank will put some of its profit into a reserve account that we could use if we had to enable us to hit that expected profit rate. And of course, the bank could just choose to forego some of its profit if it wanted to. But that's really the big difference, is that obviously it's an expected profit rate. We can't guarantee the profit rate we're offering.
But you do also offer, I've seen a kind of guarantee that if you take, say, a fixed term bond, that if you can't meet the expected profit rate, that you will pay out up until a certain point at the rate that you've.
Yeah. So again, it's not a guarantee of the profit rate. So there's a difference in the conventional market. A fixed term bond will guarantee an interest rate for a period of time. What we're guaranteeing with our fixed term bonds is the term.
Yeah.
So again, it's an expected profit rate. If we can't achieve that profit rate throughout the period, at the point that we know we can't achieve it, we give you the option to take your deposit back with all profit earned to date. We would also publish what we expect it to be in the future, and if you want to retain your money there, then you can do that as well. But again, the reality is it's not a guaranteed rate, but again, we've never failed to pay the rate because it's invested into low risk assets. We can be fairly sure that the profit rate that we select is a profit rate we can reasonably achieve.
One of the things I've seen relatively recently is you've come into the easy access market as well. So you've kind of been quite well known in our best buy tables for some time on fixed rate bonds, but you launched towards the end of last year with a fairly eye-catching easy access rate, which sadly is gone, but you still have the product and you're still competing in those markets. What was the decision behind that? What made you sort of come to the market with an easy access product?
As a bank, we'd always been strong in notice accounts. We'd always been strong in fixed term deposits. I think they were relatively easy markets to kind of break into. And as a small bank, we didn't necessarily need the amount of deposits that meant we had to be competing in all markets at all times. I think the reality is ourselves and certainly other providers, the fixed term market, while still a strong market, has probably not been as strong. I think, with low interest rates across the market, uncertainty over Brexit, what might happen with the economy, I think consumers have certainly begun to opt a bit more to go into instant access, see what happens, and then, maybe go into more longer term products at a future date. And really with that everyday saver, it was, again, not a market we competed in, so we thought we'd give it a try as we were kind of coming into a market that we felt we weren't necessarily well known in. Obviously, we thought we would have to go out with a decent rate to try and get a bit of publicity, a bit of brand awareness. Happily, it went a lot better than we thought it would, in all honesty. So obviously it lasted for about 6 to 7 weeks and then we had to take the rate away. Obviously the customers that secured that rate are still earning that profit rate. So really for us, it was just a kind of tentative steps into a slightly different market to the one that we've been used to previously.
Another thing that's I found really interesting about yourselves is that most of the new entrants that come to market and the so-called challenger banks tend to pick a fairly small niche, so they'll be online only, or you can open by online, but you've got telephone service there. You're quite unique in that you've got an offering across most channels. You've post, you've got a branch network, you've got telephone, you've got online, you've even got an app. I know that's going under more development at the moment, but what was your sort of thinking behind having such a wide proposition?
Well, again, I think this goes back to the fact that we now see ourselves as an established bank. So the bank started in 2004. We're 15 years old last year. When the bank started, it's not to say there weren't online only banks. There were, but they were kind of the exception rather than necessarily the norm. So when the founders started the bank, it just seemed, I guess, logical, to be online, to have a branch presence, tactical branch presence for us. Obviously, it's in the communities that we kind of serve. And then post and telephony, it just seemed the obvious thing to do at the time. And we still maintain all of those distribution channels. And when we launch a product, right at the moment, we kind of see no need to differentiate between the channels. You did say that obviously we're rebuilding some of our digital apps. So obviously we do see that as an important way to get to the wider market. We have our distribution channels and we're happy to use them, happy for people to engage with us whichever way they choose, to be honest with you.
I did smile when I saw you open a very plush looking branch opposite Harrods when they still had a bank.
I mean, that branch specifically, that's the Knightsbridge branch, and obviously being a Qatari owned bank, we kind of leveraged the Mashraf Al Rayan, our parent company in Qatar. So we kind of leverage a small proportion of their client base, and that branch really in Knightsbridge is to serve those sort of Qatari Arab customers.
I was reading, I think, some of your press release around the annual results, saying it was over 70% of your savers are not Islamic. I think it's often perceived in the savings market that the expected profit rate rather than guaranteed interest rate can be a bit of a barrier. But you've had some fairly impressive numbers of of both balances and customer numbers. Have you found it difficult, or is that something that's come more recently that you've overcome that, or is it still a challenge to get savers to appreciate the difference and not be put off?
I think when we were Islamic Bank of Britain, we were definitely seen as very much a niche bank. It was probably a bridge too far for maybe non-Muslim customers. That's not to say that we didn't have non-Muslim customers in the earlier days. The reality is that obviously we don't see ourselves as a bank exclusively for Muslims. So I think from about 2013-14 onwards, we've certainly, I think, made great steps with the brand and the way we kind of communicate with the market. It can sometimes be an initial barrier, but the reality is when you kind of talk to clients, when when they understand that we've never not achieved the profit rate, it becomes much less of a barrier. And as you say yourself, recent kind of FTD launches that we've done, fixed term bonds, and certainly everyday saver, we were seeing 80-90% of customers probably not Muslim customers. I think we've managed to kind of get over that issue with the market in general, but it is, it's an education piece. It's constant work we have to do just to kind of keep reminding people of it. I think we can kind of show that once we can certainly contact with the customer and engage with the customer, then it doesn't really become much of an issue for them.
I guess also, from the easy access account perspective, for a saver, the risk isn't there, because if you were to say, actually we can't meet the expected profit rate, you haven't had to have that conversation in 16 years. But if that were to change, actually the fact it's easy access would mean that we'll say there's no risk. The saver just takes the money, can just say, okay, thanks very much for letting me know. I'll take the money out and go somewhere. And
this is why we have to manage the profit rates, as closely as we do, because we're well aware that, if we ever had to have that conversation, and like I say, we haven't yet, and I don't expect we'll have to in the future, but it's a kind of a sharpener for us.
Yes.
So we need to be able to manage it.
So from a saver's perspective, actually that's a positive thing that de-risks it, but actually it should also be seen as a kind of a vote of confidence, that the fact that you have gone there, because if you weren't confident with your rates, obviously that would be a really bad thing if everyone did up and take the money out of the easy access account and go. We've sort of talked a little bit about, you've expanded into different products and the journey you've been on. Is there anything coming down the pipeline, anything on your product roadmap, if you like, that you're working on that you can talk about that might be coming for savers in the near future?
We have an extensive product roadmap, and savings accounts are always under review. We look to try and innovate wherever we can, and we do have one or two possible irons in the fire, but unfortunately
you're not able to
talk about them right at this point in time. So, but we'll make sure you're the first to know when we come to market with something.
Brilliant. We'll hold you to that. We'll have to have you back for that. I guess one thing I always ask of all guests that come on the show is, if you were Chancellor of the Exchequer for a day, would there be anything that you would do to the savings market to change things, to improve things for savers? Is there anything you'd like to see come in from the Treasury? We've got a budget coming up soon, so ideal opportunity.
Well, I'll take a slight liberty here, so I'll give you two answers.
That's fine. I like two. Two's better than none.
Exactly. So not specifically around savings, but the Islamic finance industry in the UK has actually been very well supported by governments of all colours. And I think they understand the benefit that it brings to the UK economy, not just in the amount of jobs, the tax it pays, but inward investment from investors that want to invest in the UK, but in a Sharia compliant way. Having said that, there have been innovations or advancements in the UK finance market, such as, and to pull one example out, funding for lending, which I know is not aimed at savers, but not compatible for Islamic banks. So unfortunately, it left Islamic banks at a slight disadvantage to some of the conventional banks who were obtaining cheap funding. So whilst we wouldn't ask for special favours, one of the things that certainly our bank and the industry would like to see is a bit more of a level playing field for Islamic banks and Islamic financing industry in general.
Okay.
Specifically relating to savers and personally, so again, I think the government's been supportive of savers over the last few years, particularly the personal savings allowance. I thought in principle was a great idea. My only concern with the personal savings allowance was that we already had quite a good tax-free brand in ISA.
Yeah.
And as good as the personal savings allowance is, I actually think it probably confuses or makes savings a little bit too complex sometimes. So you get your personal savings allowance, you get a promotion at work, a job, suddenly that can reduce overnight by half. And I'd rather see, to be honest, the personal saver allowance going, but a more generous ISA regime.
Okay.
So maybe an extension. The two things with the ISAs, an extension of the allowance, but also flexibility across the balance, not just across the, the new subscription on the year.
Okay. So that people can move money in and out?
In and out of an ISA and just make it a relatively freely simple savings product. So it's like I say, I think the government's been a great supporter, but I just think the personal savings allowance, probably it's another thing to think about when you're saving now, isn't it? And really, yes, savings products should be simple, straightforward. Having had the ISA regime in place, and it's a brilliant brand that's been really successful, I'd be looking more at kind of making that a bit more generous. I'm
hoping that they are going to do some reform there, because I think it needs it. I think you're right. Well, I've beaten the drum on this a bit in the past. I think ISAs have become more complex. They were created. The word you used was simple, and they were created. Sadly, I'm old enough to remember the days of Peps and Tessers, and they were brought in to simplify that regime, and they've largely achieved that. But I think I'd agree with your thoughts. I think generally in more recent years, the government has been very supportive of savers and introduced a number of initiatives to try and improve savers. I think the downside of that has been that the amount of initiatives that have been brought in have now muddied the water somewhat.
Absolutely.
I think it does need some reform. I guess I'm going to get you to pin your colours to the mast. Do you think we'll see any in this budget round?
I don't know, because I think there are probably more telling and pressing things that they're trying to be resolving at the moment. I think changes to ISA or PSA down the line things, I think, to be honest with you.
Yeah, I think I'd agree with you too. I think we may see some changes to the allowances. Whether they'll be just cost of living or CPI based increases to ISAs and to the personal savings allowance, or whether they'll be more binary, put another 1,000 or 2,000 or 5,000 on. I'm not sure, but I think probably that's the best that we can hope for. And I think the worst case scenario, and possibly a scenario that might play out, is actually there's no change at all. Just leave the allowances as they are, and say, well, actually we'll use that as effectively the inflationary element to claw a little bit back from those. But we shall find out relatively soon on that one. I guess talking of changes to the savings market, we've obviously seen a large number of new banks come in the 16 years that you've been in existence for. How do you see the sort of savings landscape playing out in the next few years? Do you think we're going to see more new banks in the market, or any other significant changes that you see coming down the line?
I think there'll be more banks without a doubt. I mean, we all know there's lots of banks kind of sitting in the authorisation list, just waiting to get permission to kind of go. The savings market for me is interesting. They are meant to be relatively simple products. Innovation is great, but I think innovation in savings, we just need to be a bit careful. Because going back to previous, savings should be simple. Whether we'll see anything truly unique in the savings market, I'm not too sure. I think certainly open banking is something to keep an eye out for over the next 5 years. It's in place now, starting to gain a bit of traction, but I'm not really getting the feel that many consumers are even really aware of it or taking advantage of it. I think the big game changer on that comes when, a third-party provider, TPP, gets more into active savings, where they're kind of consumers are actually almost allowing them to kind of move savings around. I think that could be a game changer, but I'm not really seeing that at the moment. I think it's still kind of baby steps on the TPP side.
Yeah, I think we saw a lot of kind of hype around open banking, but I think those of us in the industry knew that the big banks really weren't geared up for it, and then we saw a number of them apply for extensions, and I think a lot of financial commentators probably hadn't appreciated the complexities around in it, and we're almost predicting a sort of day one we were going to see a kind of gold rush of new sort of shiny things come to market that would change the world. Whereas I think what we have seen and what we continue to see, it was interesting you said over the next 5 years. I think we're kind of 2 years in now, and I think it will be a 5-year timeline before we see any real material change, or consumers see any real material changes that actually significantly impact on their day-to-day banking relationships.
It's a huge education piece, because you're almost asking consumers to give access to all of their savings to one provider they may never have heard of before. I think once that kind of education piece is won, then the sky potentially is the limit for open banking, what it brings. But it's like we say, I think that's still some years away.
You mentioned sort of third-party providers there. There's been quite a few platforms come. We spoke to Kevin Mountford at Rayan in one of the earlier shows. Do you think we'll see a trend for those to continue to grow? Do you think they will take advantage? They'll be the area that seizes on open banking and take advantage?
Quite potentially, yes. I mean, the concept, I think, of companies like Rayan and so on, I think it's a great concept. I'd probably suggest at the moment the marketplaces aren't, they probably need a bigger name on there to really start bringing the volume in. I might be wrong on that, of course, but it's this sort of combination between the technology of open banking and providers like Rayan, and I think those sort of providers are well placed to benefit from open banking. But again, there's a big education piece on what the benefit those marketplaces for consumers.
I guess we've covered quite a lot this afternoon. If you had one message to give to savers who haven't yet given yourselves or any of the other Sharia banks a try, what would it be?
Well, give us a try. The reality is what we try and say. We don't pay interest, but the outcome's the same. We're working hard to give our savers a really good return, a really good value return. And certainly the feedback we get with our customers is that once they've tried us, they're more than happy to open another account with us and open multiple accounts. So all I would ask people is, give us a try.
Yeah.
And, hopefully we'll see more customers coming to us.
Well, it's been a pleasure to talk to you, and hopefully you've lifted the veil on Sharia banking for some of our listeners. It's been fascinating to learn more, and I look forward to having you back when you can tell us a little bit more about what you have got in the pipeline, and we'll keep our eye out for those developments as well.
Thanks for your time.
Thanks, Mark. Thanks for joining us. That's all for this episode. Thanks for listening in, and look forward to hearing your feedback as ever.